I don't understand the purpose of this product. Who is whole life insurance for, and who doesn't benefit from it?
It gets sold to people who don't need a death benefit when they're 92.
Why spend more money on that? It just makes no sense. And those are the decisions that are going to make or break you. It can be amazing, but it can also be a little misleading.
And so naturally, you would expect whole life insurance to cost a lot more than term life insurance, and indeed it does. Depending on your age and health status and that sort of thing, it's typical to pay 8 or 10 times or 20 times as much for the same death benefit. If you die at 55 and you got $1 million in term insurance, you get $1 million. If you die at 55 and you got $1 million in whole life insurance, you get $1 million. That's it. It's the same death benefit.
So I just showed that, and I just went through that exact example, and I just basically, and now the rule of thumb here is if you are super unhealthy, then obviously the cost of the permanent insurance is going to be more if you can get it at all. But in that situation, the more unhealthy you are, the more value there is in having the life insurance, because the more likely it is that you're going to have something catastrophic happen to you.
And so that is the overview of whole life insurance. And people think about it that way, and that's the way most of them should think about it. You go, of course I don't need to have insurance after I'm 65. Of course that'd be expensive. All kinds of people are keeling over after age 65. I'm not going to buy that. The problem comes in that there is a lot you can do with whole life insurance besides just get a death benefit. Because the way most of these cash value life insurance policies work is they accumulate cash value as you go along. And that, is useful. Obviously, everybody likes cash, right? And so it's good to have cash value. That's not a bad thing. But if you pay into a policy, a whole life policy for 10 or 20 years, maybe you've got some cash value there. Maybe it's $50,000 or $100,000 or whatever it might be.
Did he really just say that? Like I just showed you at, let me see here. I gotta get into here and see at year 20 in this example with a $12,000 a year premium, you've got $509,000. Okay, $509,000. And you only paid $323,000 into it. So it just shows his statements are so leaning towards this argument that he's trying to sell you into something.
And you are actually allowed to borrow against that. You can get a loan from the insurance company with that cash value as the collateral.
Mm-hmm.
And so that introduces all kinds of opportunities, right? You can borrow against it. You don't have to go to the bank to borrow. And it allows for all these other uses of whole life insurance. Somebody might want to use it as some sort of retirement savings, or might want to use it as a college savings, or to fund the purchase of real estate, or as some sort of emergency fund. There's all these other uses now you can use the policy for.
Mm-hmm.
And so that's how it gets sold. It gets sold to people who don't need a death benefit when they're 92. It gets sold to them as another retirement account. It gets sold to them as a college savings plan. It gets sold to them as an emergency fund. It gets sold to them as you don't have to go to the bank now and borrow money. You can just get it out of your whole life policy. And the truth is, for almost every one of those uses, there is a better method than using a whole life insurance policy. And that's God's honest truth about whole life insurance. I don't sell it. I don't benefit if you don't buy it. I don't benefit if you do buy it. But that's the truth about whole life insurance. And, you can dive into the details of all these different uses and why whole life is maybe not the best way to meet that need. But that's kind of the broad overview.
So Jim, why is whole life insurance sold so hard? Why are there so many proponents that are so hardcore about this product?
Well,
I love how he just drops that and he's not willing to get into why. He's like, I'm going to tell you all these things. I'm not going to get into why. I'm just going to talk about why people are selling it. He's not even backing up his statement. So I hope he does actually get into it and back up his statement.
Find that 95% or more of the proponents, it might be 99% of the proponents, sell it for a living. Okay, so there's this huge conflict of interest.
Is this a lucrative way to make a living?
People may not realize how lucrative it is. The typical commission on selling a whole life policy ranges from about 50% to 110% of the first year's premium.
So that is true for policies that are designed improperly. If you design a policy improperly, and that is like what I said at the beginning, my guess is he had some experiences with people that were a little unscrupulous, or maybe not even unscrupulous. They're just maybe a bit traditional, and they did things in a traditional way, and they sold full base policies or mostly base policies. And with that, commissions are higher, and the commissions come out of the cash value, right? So what I showed you there on the policy that I showed was $100,000 going in year one, but you could see that there was almost $93,000 liquid. That means out of that, commissions only get generated really on just under $7,000. And so then you're only making like 50% of that. So the commission rate is like 3.5% of the total premium. So like when you really break it down, or maybe let's call it 7% of the total premium. There are mutual funds out there that have load fees and all these different things that go into it that are as high as that. There are other financial products that have commissions that are far greater than that. When you look at the commission on a whole life insurance policy over the lifetime of it, of the way we design policies, it is like far less commissions paid than managed money fees or commissions paid to advisors for managing money on investments. And so that's the part that I think is missing here that he's not talking about. So let's keep rolling.
So if your premium for this policy is $20,000 or $30,000 a year, which is not unusual at all in my audience of physicians,
Yep.
that person is getting
go to
paid
$12,000.
$10,000, $20,000, $30,000 to sell you this policy. Yes, they're going to try really hard. How many of those do you think they need to sell a month to have a fantastic income? Not very many, right? So there's this huge conflict of interest.
He's not wrong.
There are some people out there, including many of those who sell it, who don't really understand how it works. And they think about all these different uses of it and think, it's the Swiss Army knife of, financial products. So of course it must be awesome because look at all the different stuff you can use it for. But when you dive into the details, that's where you find the devil. The devil's in the details, and it's not very pretty when you do.
What is that quote? It's difficult to get a man to understand something when his salary depends upon him not understanding it.
Exactly. I think that comes from, a novel about the meatpacking industry is what it came from originally, but it can be applied to just about anything.
So I just want to chime in here that I host a podcast here with Mindy on financial responsibility, and I got referred to a financial advisor through a lawyer or whatever to talk about some things, and sure enough, the conversation goes around, and I'm like, I think this is all reasonable, up until, you should get a whole life insurance policy. Alarm bells start going off. You should get a policy not just to put you to financial independence, but to insure against all of the future income earning potential that you have in your career. Have you heard that one before?
Well, I mean, that line can be used to justify the sale of lots of types of insurance, whether there's disability or term life or whole life insurance. They have an incentive to get you to buy as big of a policy as you will buy.
That's such garbage. That's malarkey. I'm sorry. But all right, so I'll tell you right now, I get as much insurance as I possibly can get. Why? Because my values are what they are. By our philosophy is buy your net worth and build your cash flow. And so the challenge, I think, with people like this guy is that he's a W-2 doctor or, whatever. And he's not really an entrepreneur, although I would argue he's probably more of an entrepreneur than most doctors because he's this content creator. He's got all things going on. But when you think about it as a buy your future net worth, that's coming from a perspective of, I feel like I have a responsibility to leave the next generation better off than what I have, right? Like I feel a responsibility to leave money and rules and system and maybe have a trust manage the money so I can make sure that what I want to happen in the next generation is actually accomplished. I go through my life right now trying to think about the fact that I'm not doing it all for me. I enjoy the game. I enjoy the work. I enjoy the life. I do all this stuff and it's a lot of fun. Don't get me wrong. But I'm doing it mostly because I have 3 kids. I'm doing it for my grandkids that I've never met, that are probably not going to be born for another 15, 20 years. I'm doing it for the fact that I want to leave my kids more opportunity. I grew up in a trailer park. I grew up with nothing, right? And I grew up with a lot of love and great parents and whatever, but I really feel like he's missing the boat by not acknowledging the fact that with his mindset and what he's talking about, so scarcity mindset, he's saying you don't have a responsibility to take on anything to help the next generation. And he's like, just take care of the bare minimum and don't buy as much as you possibly can, because if you don't need it, don't do it. The beautiful part about life insurance, you can't say this for all insurances, but for life insurance, if I want to make sure that I'm working and saving and getting to a place where I have $4 or $5 million of money that I want to pass on, if I'm working right now, I have the ability to go out and buy that result. I can get that result locked in by buying that insurance. Now, hopefully, I don't die. Hopefully, things go and continue to go as they're going right now. And I live a long, healthy, happy, fruitful, productive life. And if that's the case, that's amazing because I'm going to build more cash flow. And as I have more cash flow, I'm going to keep being able to fund my real estate and do my projects and do the things that we're doing. That's going to build more cash flow. It's going to create more net worth. And guess what? That's going to create taxable issues for me for my estate. And that's going to make it so having a whole life insurance policy on the back end will be amazing from an estate planning perspective. The problem is if you wait until it's too late, until you actually have that problem, it's going to cost so much that you're not going to be able to deal with it. On top of that, if let's say I get to the end and I didn't save as much money and I don't have as much in a whole life policy and I don't have this taxable event potential in my estate planning needs, I still have that money there in case I need it for living benefits, in case I get sick, in case I need long-term care help, all these things. Once again, these issues that people wait too long to get, right? People, when you wait until you're 55 or 60 to get long-term care insurance, it's so cost prohibitive. It's not even funny. Whole life insurance, when you look at it, he said it himself. People say it's a Swiss Army knife. It is the Swiss Army knife. It's the only product in the world that will grow with you through every stage of your life. That's not some stupid sales pitch. That's the reality that we live in. Okay. So, man, and I'm telling you, white coat investor, give me a call. Let's debate. Let's do this live. Like, because I'll invite you down to my hotel here in the Dominican and we can do it live. I'll put you up for a week and come on down.
You know, but you have to, when you're buying insurance is not a good deal, right? People need to understand insurance is a bad deal. It's always a bad deal.
Not a
because
bad deal.
It has to be a bad deal. Think about what happens. You pay a premium. You and 1,000 other people pay a premium, right? And the insurance company takes that premium. It pays for all of its expenses, including commissions to its agents, its overhead and all that sort of stuff. It probably wants to make a profit, you know, if it's a for-profit insurance company.
When you buy a policy with a mutually held company, you are a profit. You share in the profit. You're like a shareholder of the company. And so you are sharing in the profit of the company. That's how it works. And so you want the company to be profitable because they pay that through as a dividend with the policy.
So it's going to take a little bit of profit. And then, of course, it's got to pay any claims that come out, all out of that premium. So on average, insurance is a losing proposition. On average, you will always come out behind buying insurance. Now, I'm not saying don't buy insurance when you need it, but recognize that it's a bad deal for you. And so you shouldn't buy any more than you need. And indeed, I think if the plan, let's say you're married and the plan is for your spouse not to have to work if you die, if you get hit by a bus tomorrow. If that's the plan, then yes, that term life insurance policy needs to be large enough that they become instantly financially independent when you die. And they can live off the combination of what you've already saved plus the life insurance proceeds for the rest of their life, if that's your goal. But do you have to absolutely replace every dollar you ever earn from here on out? No, you don't have to do that. You just got to look at what your needs are and buy enough insurance to cover those.
As we were preparing...
Look at your needs or look at your wants, and they're a big difference.
This show, my producer, Kaylin, said, I don't understand the purpose of this product. Who is whole life insurance for? And who doesn't benefit from it?
Okay, well, this is the thing that makes it hard because there are a few people and a few situations where it does make sense. Okay. But if you will take as the general rule that you don't want this, that it is a product designed to be sold and not bought, that the person talking to you has a huge conflict of interest selling it to you, if you will have that as your general background mindset when you interact with anything and anybody about whole life insurance, you're going to be right 99% of the time. Okay, but there are these situations where it can be useful. Let me give you an example. Okay, let's say there are two older business partners. Okay, and they own a business, and it's a great partnership. It's a great business. They love it. But their plan is, if one of them dies, they want the other person to basically get the business. They don't want to be in business with one of the heirs, one of the crazy spouses, whatever. And they're kind of older, and so term life insurance that would pay off and produce money to do a buyout of the other partner's estate is kind of expensive at that age, So they decide, well, let's do that with whole life insurance. So they buy the business buys a whole life insurance policy on each of them, with the idea being if one of them dies.
I got news for you. If this is the case and he's talking about that term life insurance, he's speaking out of both sides of his mouth, dude. Come on, man. Like if you have a business and you're under 65, you can most likely get a term life insurance policy still anyway. Okay. Like you can still go do that. And is it going to be expensive? Yeah, it's going to be expensive because you're 65 and you waited till you were 65 to have insurance. Okay. Maybe when you started your business in your 40s or, whatever, you should have gotten a whole life insurance policy and it would have been a fraction of the price and you would have had that buy-sell agreement in place the whole time. But if he's talking about buying whole life insurance that's going to guarantee life insurance for the rest of your life in that time frame, then buying whole life insurance is going to cost a lot more. Ironically, I actually disagree with him in this sense. I think this is a place where a lot of times term life insurance is better because if you know that you're going to only have the life insurance, have the business for a finite period of time, and you know that you're going to get rid of the business and that you don't need it forever, and that when you sell the business, the policy can go away with it. If that's the objective and that's the problem you're trying to solve, well, then why go spend more on a whole life policy, when you can buy a term life policy that's a 10-year term and in the next 5 years you're going to sell the business, right? Like, so why spend more money on that? It just makes no sense. So he's speaking out of both sides of his mouth, and that kind of stuff drives me crazy.
That whole life insurance policy proceeds are used to buy out that partner's heirs. And so the person that's remaining can keep the business. It's a great use of whole life insurance. Here's another example. Some people in estate planning want to get some assets out of their estate to keep themselves below the estate tax exemption amount. And so they put it into an irrevocable trust. Once it's in the irrevocable trust, all the growth in that account, in that trust, is not subject to estate taxes. And so if you have something that's going to appreciate a lot, a business, you try to get it into a trust like that before it really booms. Investments can go into a trust. But a lot of people don't like the fact that trusts get taxed pretty heavily. You hit the top tax rate in a trust with pretty low amounts of income. I think it's less than $15,000 a year, and all of a sudden you're in the top tax bracket in that trust. And so sometimes what people do is they put a whole life insurance policy inside that irrevocable trust because it grows in a tax protected way. There's no income being kicked off from it that you have to pay taxes on. The dividends from it are treated essentially as return of capital, like as though you overpaid the premium. And so it basically grows in that respect tax free. And then whenever you die, the death benefit comes into the trust and goes to, the trust beneficiaries. And so that's a use that some people find for it. Occasionally you'll find somebody.
Okay, so what he just said was that the dividends were paid as a return of capital. So one of the things that I want to do right now is I actually want to go back to what I was talking about before and talk about that concept, because Dave Ramsey talks about this all the time as well. And when he talks about the return of capital, this is basically what they're saying is the dividends are paid out as a form of overpayment of premium. So if you think about that, principally speaking, if you're getting back a portion of an overpayment of premium, that by definition means you're only getting a portion back of the overpayment of premium. Therefore, you could never have more cash value than you actually paid in premium, because if you did, then it's actually more than that. You're participating in the actual success of the overall profitability of the company. When they say you're participating in overpayment of premium, they're talking of all of the premium that all of the insurance company is deriving, even from term insurance, right? So you got all the mortality costs that come along with the term insurance that goes in, and the whole life insurance policyholders benefit from that. And the reality is, if you look at the numbers, once again, if we were just getting back an overpayment of premium, well, then how at year 10 have we paid in $208,000 and do we have $246,000? If it were an overpayment of premium, all of a sudden the life insurance company's going broke because they paid you more than you paid in premiums. And so that is what it is. You have to understand, I don't care what the laws say about what this is. This is where I say I'm not big on all this conspiracy stuff, but I will say this. This is where whole life insurance code was created to make it so the way dividends are paid out were categorized so they could have all these tax benefits, because when it goes all the way back to 1913 in the institution of the Federal Reserve Act and the banking system that we live in and how they make all this happen, dividends have been paid this way because the people that put their money in here, and when they changed all the banking code and all the regulations that go along with it, there have been different variations, and they've changed, several times throughout the years. But the one thing that never has changed is the fact that this overpayment of premium element is simply in there so you don't get taxed on your dividend growth. So the people that were launching the banking institutions in 1913 that had previously relied on life insurance companies to be their safe place for capital, and they kept doing it. JP Morgan, like all the people back then in the Carnegies and all that stuff, they were utilizing whole life insurance as their savings vehicle. This is why the top holders of life insurance in this country, whole life insurance, are banks in this country right now. And so it's not an accident. This is not it's not rocket science here. So what I'm going to do is I'm going to stop sharing this again. I'm going to go back and I'm going to start sharing the other one again, and we will continue on. Here we go.
that likes to do, and these are trademark terms, bank on yourself or infinite banking or leap. And these are basically systems where you can borrow from your whole life insurance policy rather than going to a bank to borrow money. And in the short run, it's not a very good deal. In the long run, you might earn a little bit more on your cash doing one of those sorts of policies. And so, when I run into real estate investors that are interested in whole life insurance, that's usually the use that they are thinking about, and so that can be a reasonable use as well. Those are probably the three most common ones that I see people out there. And occasionally someone just...
Interesting, he's on Bigger Pockets and they're railing on whole life insurance. And now he actually just admitted, real estate can be a good one where it can be used. Yeah, but I bet you they blow right over it. I don't know.
Wants a permanent death benefit. They got a disabled kid and they're like not quite financially independent yet. They're 68 and they're still working, and they want that kid to be taken care of when they pass. And they're like, term really doesn't make sense for me at this age. So I'm really glad I picked up that whole life policy at 45 because the premiums are still level. You'll see occasionally people like that. I think most of the time, even people with disabled kids don't need a whole life insurance policy, but that's not a terribly bad idea for using it. But just being a doctor, just making a lot of money, just being a real estate investor, these are not reasons to buy a whole life insurance policy.
Can we dive a little deeper into that third use case for the real estate investor with infinite banking? What do you have to believe and what do you have to do to actually make that a reasonable investment?
Okay, so here's the problem with these systems. They are sold as like this, life-changing financial product that everything's better once you buy this thing, and of course that's just people trying to earn a commission.
To that point, I will acknowledge that is what most people do, and it's like everybody says this product is going to solve all your problems in life, and nothing could be further from the truth. It is going to help you be more efficient in a lot of ways, but I probably would agree with him more than not in that statement.
But if you boil down to it, if you really dive through all the details, what you are trading is something that gives you a bad return for 5 to 10 years in exchange for earning a little bit more on your cash in the long run. That's essentially...
I just showed you what it looks like. I mean, we're literally beating a bank account in the first 5 years. And you're picking up all that death benefit and you're eliminating the need for the term insurance that you would have. So you're saving money there. So that's even more efficiency.
Essentially what you're getting. That's the swap. Forget everything else they tell you about it. That's what you're swapping. And if you're willing to deal with the hassles of life insurance, buying the policy, funding the policy, dealing with the negative returns for the first 5+ years, what you get is you make 4 or 5% on your cash instead of 2 or 3%. Well, right now you can go make 4.5%.
That's a big deal, by the way. He ignores the fact that 5% instead of 3% is a 67% improvement. Okay. First of all, there's that. But on top of that, what he doesn't talk about are the other benefits that come along with having that kind of liquid access to capital for real estate investors is the fact that right now with mortgage rates, especially on investment properties being so high, if you have money capitalized in a whole life insurance policy that you can get access to right now for 5.2%, which is what the rates are right now, going to get a mortgage on a second home right now, you're talking 8-9%. And so if that's the case, what is the value of that extra 4% that you can save and use that money as a down payment? Whatever you have on in your whole life policy, you could borrow against that policy, put 25% down on a rental property. Now you basically have self-financed through your own policy, your second mortgage on the place. You didn't have to come out of pocket for the down payment. You can pay it back with the cash flow from the rental property. You pay back and you recapitalize your account. All the while, your money's still growing on your policy. That's the way that this works. The problem when people like him are talking about the negatives, they're only looking to the cash on cash return. They're not looking at the benefit of the leverage of access to that capital and the savings and the control that comes with it. Now, it's not a one size fits all. The value of control of the capital inside the policy is going to have different value based on who has control of the capital. It can come with downsides too, right? Like if you have access to $500,000, like we showed here earlier, and I have access to $500,000, that has different value of control. Maybe you're somebody who's further ahead than I am. And so and you have different skills and different access to deals and different abilities of yourself. Maybe it's more valuable to you than it is to me. It's more valuable to me than it is to somebody else. And so maybe you're a complete degenerate, and having access to that kind of capital would be detrimental to your life. And so at the end of the day, there's no one size fits all. What I cannot stand is when people position this stuff as there's these one size fits all statements one way or the other. I agree with him. There are too many people online right now that are selling infinite banking, selling bank on yourself, selling whole life insurance. Ultimately, too many people are selling index universal life as this solution, and they're bastardizing the entire industry. They're making it way worse. And I bet you white coat investor guy here and me would both agree that IUL is absolutely atrocious. So let's keep going.
In a money market fund anywhere. But, a year or two ago, you can see why that would be an attractive proposition to be able to make, 4% on your cash long-term instead of the 1% you were making on your high yield savings account a year ago. But you have to make sure if you're going to do this, anytime you buy a whole life insurance policy, it's like getting married, right? It's till death do you part, or it's going to cost you a lot of money to get out of it.
That's not true.
So you want to do appropriate amount of due diligence. If you've only looked at one policy, what in the world are you doing?
I agree with him. You got to look at more than one policies. That's why whenever we're working with anybody, we always look at 5 carriers. That is what it is. That's first and foremost. And secondly, it's not till death do you part. If you understand the 7 pay rules, you have 7 years that you are going to be committed to premiums. If you do it the right way, the way that I designed it and showed you in the policy, there's even flexibility in that 7-year window. But on top of that, at year 7, you could literally do a thing called reduce paid up, where you can reduce the death benefit, fully pay up the insurance, and now you got a bank account on steroids effectively, where the cash is going to keep growing. You have no more expenses, no more insurance charges, no more anything, and the cash is going to keep growing at a better rate from a long-term perspective than your bank account, right? And so once again, just not accurate. Be careful with your words.
Buying it. That's like buying an investment property with only ever looking at one property. It's crazy. And so if you haven't gotten opinions from more than one person, including one who does not benefit from selling you a policy, and you haven't looked at multiple policies, you're probably not going to buy the right one. But there are policies that are designed to do this bank on yourself, infinite banking, whatever you want to call it type of thing. And they basically have 3 characteristics. The first one is that most of the money going in there, or at least a large chunk of the money going in there, is not regular premium buying regular whole life insurance. It is what's called paid up additions.
True.
Okay? And so what you're trying to do is get more money in there quicker. Mm-hmm. And the paid up additions pay a lower commission than the regular insurance policy.
Much lower.
And so it's a little bit of a more cost-effective way to buy the policy. So that's number 1. Number 2.
No, it's a lot more of a cost-effective way to buy the policy.
2, you want the policy to be non-direct recognition. Now, a typical whole life policy is direct recognition. And what that means is when you borrow money against it, that money that you borrowed out of or against the policy you're no longer being paid dividends on that money that you've borrowed out. A non-direct recognition policy still pays you the dividends.
It's not that they no longer pay you dividends, it's that they reduce the dividend scale on a direct recognition company. I'm going to let him finish this, and then I got something to say about it.
So you borrow this money out, and it's still paying you as though the money's still there. And so that's not all policies. And if you're going to do this, where you're repeatedly borrowing against your cash value and paying it back, you want to make sure that you've got a policy that actually recognizes, the borrowing against it as non-direct recognition. And then the last thing is you want wash loans, which means that the dividend rate it's paying is about what it is costing you to borrow the money. Because when you borrow against your whole life insurance, anytime you borrow money, it's tax-free, right? And they make us, it's tax-free, get your money out tax-free.
Mm-hmm.
Well, anytime you borrow money, it's tax-free. You borrow against your house, it's tax-free. You borrow against your car, it's tax-free. You borrow credit card money, it's tax-free, right? This is not some new thing that's fancy about whole life insurance. But, but you want it to be interest-free, and it's not interest-free, right? When you borrow your own money out of this policy, you're paying interest. But at least if it's a wash loan, if the interest rate is what the dividend rate is on this policy, then at least, it's not really costing you anything to borrow it, to get your money out.
So from this perspective, there's a couple things. It's not necessarily as big a deal to be non-direct or direct recognition. So this is where he's kind of missing the point a little bit. I am a fan, just for full transparency, I am a fan of non-direct recognition for all the reasons that he said. My favorite companies are non-direct recognition for the reasons that he said. However, if you look historically and you understand the market and you understand the industry and you understand the interest rate environment and the history of dividends and the way that life insurance companies work, from 1980 to basically last year, the interest rate environment was really high. It went low in 2009. It dropped out. We had quantitative easing 1, 2, and 3. We had all this money printing and the stimulus and all these things. And then, of course, we had inflation, so interest rates went up. And during that time, until interest rates started coming back up, we were in the longest, from 2009 to 2021, we were in the longest low, or 22, longest low rate interest rate environment that we've ever been in. We never experienced anything like it, right? And so with that, that created this environment where dividend rates went down and down and down and down. And it created this kind of arbitrage for life insurance companies to be able to credit or charge less of an interest rate and then be able to credit a little bit higher on the dividend side of everything. But the bottom line is how companies work on a declining interest rate environment versus how they work on an increasing interest rate environment. Dividends typically have a habit of chasing interest rates. So when interest rates are going down, dividends are going to be a little higher. As interest rates are going up, dividends are going to be a little higher. I will agree with him. If you're going to be super active with borrowing, non-direct recognition is the way to go. But if you're going to be somebody who's here and there, going to do it, maybe going to do one deal here and there, a direct recognition company can actually work better, because typically what they're going to do is have a higher dividend rate on the front end. Even though if you borrow against it, they're going to lower your dividend scale for the money that you have borrowed against it, their dividend rate will actually be higher. There are no free lunches. He said it. There's no free lunches when it comes to life insurance. They've got it all figured out. It's just whether you choose non-direct or direct recognition is all based on your behavior with the policy and how you plan to use it. So that's one of the reasons we love to coach people through this, because those are the decisions that are going to make or break you. It can be amazing, but it can also be a little misleading. And I think he's trying to protect people against being misled, which from that perspective, I can at least respect.
In that respect, it's kind of like withdrawing out of a bank savings account. You pull it out of your savings account, you're earning 5% on it. It's costing you 5%. That's the same as if you pulled money out of a savings account. And so what this is it's functioning as a savings account. And for the first few years, it takes a while to break even on whole life insurance, because you got to pay this huge commission, right? And so even the best designed policies, they still don't break even for 4 or 5 years. You might have paid $100,000 in premiums over the last 5 years, and your cash value, if you walked away at this point, might still only be $92,000. You're actually behind. And so for the first 5 or 10 or 15 years, you're behind where you would be if you just put that money in savings.
I'm not even going to answer.
But after that, you're probably ahead
in
most situations, assuming you bought a policy that's actually designed to do this. And then instead of pulling money out of your savings account or trying to get a loan from a bank, you're just borrowing against your whole life insurance policy. So you might, borrow $100,000 against the policy, buy a property. As that property makes money, you pay that loan back, and then you pull it out of there and buy another property. That's how it might be used by a real estate investor.
And that part's great, by the way. So that's I wrote my book, Cashflow Hacking, because that element of utilizing whole life is great. And I will say this, one of my principles, period, is that you only use your policy for cash flow producing assets, right? And that's why I love real estate so much. I could also use it for business, right? You could use it for investing in yourself, because you are the best cash flow producing asset in your own life, I hope. And if not, maybe you should address that. And so, cash flow producing assets is how I utilize the policies and how I coach everybody to utilize the policies. And the challenge is when people try to get tricky with whole life insurance. This is probably where I would agree with him. And he probably, I don't know, I've seen him talk about stuff of this nature in other spaces. I don't know if he's going to get into it in this video, but challenges are agents that are out there positioning people to fund and flow all their life expenses through these policies and whatnot. And that makes no sense. The only depreciating asset I would say makes sense is your car. Any kind of car, any kind of thing like major capital purchase of that nature for businesses, especially if you have a business and then buy a car, buy major equipment, buy something like that. You can actually take a loan from your policy, pay it. You can write off it, talk to your CPA and stuff, but you can write off the interest expense. So it becomes a tax deduction on the write-off of that. And plus you're never interrupting the money that's growing in your policy. And I've done examples that have shown people just the way you buy your cars. If you flow it and fund it through your policy properly, you can have an extra $250,000 in your whole life policy account, just the cash value, just through the way that you purchase those cars instead of using a bank to pay for those cars, right? And so that's just something to take into consideration. So here we go.
Policies available now with the wash loans and the I can't remember what you said, the still earning dividends even if you borrow against it.
Yeah, the
Oh, by the way, that wash loan concept is kind of hodgepodge. You can make positive arbitrage in certain environments. They may be negative right now. Like, so for instance, right now, if you're getting a 5.5% loan and you're earning a 5.25% dividend, for instance, so you're negative there. My coaching to everybody is that if you understand the fact that your loans are simple interest and you're earning compound interest, the biggest key here is you have to manage the interest on your loans. But as long as you manage the interest on your loans, I could show you mathematically, factually speaking, and I will debate anybody on this anytime, anywhere, that you could pay 7.5% on a loan and only earn 5% in a dividend, and you're still going to come out ahead with that, because it's not the same thing. You have simple interest versus compound growth. And now simple interest turns into compound interest if you don't manage the interest expense every year. And that's why I say it's important that you invest in cash flow producing assets that will at least help you manage the interest expense on the loans. But it's sophisticated stuff and you got to understand it.
Direct recognition. Yeah, you can buy them.
You can still buy them. Okay.
Yeah, you can buy them. They haven't gone away or anything. It's not every policy though. You got to recognize that Joe Blow walking in from, Northwestern Mutual or New York, or whatever, walks in and tries to sell you this policy so he can make his $30,000 this month. It may not be the policy you're looking for. And so it helps to have someone that's been doing this for a while, that knows exactly what you want. But this is on you too. You've got to make sure the policy has those features.
100%.
Because they don't all have those features. Now, it's not like those features are free either, right? I mean, if you're going to get non-direct recognition loans, you're probably giving something up. And it's probably the dividend rate. You probably have a little bit lower dividend rate on that particular policy. So in order to be able to borrow money out against it routinely like that, you may have a slightly lower long-term return if you didn't borrow the money out of the policy.
Yep. For so thoroughly debunking the 99% of use cases of whole life insurance products, you are very knowledgeable about the various use cases in that tiny 1%, which I find really interesting here.
The problem is these agents, these salesmen, what they do is they bounce from one use to another until they find one that jives with you. And then you're like, oh yeah, and then they sell the policy. But they're very good at it. The only way to win this argument with a whole life insurance salesman is to stand up and walk out of the room. You cannot win the argument if you stay there in that chair in their office. You're not going to convince them it's not a good idea.
The whole life insurance agent is not listed. They're not presenting themselves as a whole life insurance salesman. They are presenting themselves as your financial advisor, right? Your CFP. That should be, and it's implied in the conversation with these folks many times that they're going to have your best interest. They're your financial planner. You trust them with your financials, but it's not a fiduciary role in most cases for most folks selling these policies, correct? True. And if so, who should I go to if I'm in one of the very rare use cases that...
But I got news for you. Most financial advisors are not fiduciaries either. So that's kind of a double speak there. So